Welcome to This Explainer. Okay, let's dive right in, because the world of investing has fundamentally shifted. For decades, doing deep, highly analytical pre-trade analysis, running 1,000-variable stress tests and scraping the entire internet for market sentiment, well, that was a luxury. It was something reserved entirely for massive institutional hedge funds with huge budgets. But the explosion of accessible AI tools, it's a total game changer. Today, for the modern investor, utilizing AI for pre-trade analysis is no longer an institutional luxury. It's an absolute retail necessity. In this explainer, we're going to explore exactly why that is. We'll pull from top-tier research, platform reviews, and academic data to show you how AI can completely transform your approach long before you ever click buy.
Because we're synthesizing some highly technical information today, here's our roadmap to keep things logically structured. We're going to cover the pre-trade AI shift, reading the market's mood, stress testing your portfolio, spotting the next crash, explainable AI, and finally, the modern investor's workflow.
All right, Section 1, the pre-trade AI shift. Let's look at the hidden danger of portfolio drift.
We really need to set the stakes for what investing looks like right now. The biggest danger to your wealth today isn't necessarily a sudden, dramatic market crash. It's actually the silent drift of passive portfolios. When markets move fast, a set-and-forget portfolio can quietly drift into a massive danger zone without you even realizing it. Take this specific story highlighted by MoneyFlock. Back in April 2026, a longtime reader finally checked his portfolio. He'd initially set it up with a moderate, balanced risk profile. But after 2 solid years of an AI-driven equity rally, he looked at his numbers and realized, shocker, he had become 22% more aggressive than he ever signed up for. And the crazy part, he didn't make any reckless trades. He just did nothing while the market rallied. His risk profile had unknowingly spiked, exposing him to massive downside if the tech sector were to correct.
His target was perfectly sensible: 60% stocks, 30% bonds, and 10% cash. But reality? It had drifted to 73% stocks, 21% bonds, and just 6% cash. Honestly, think of your portfolio kind of like a sourdough starter. Left alone, it works for a bit, but if you never feed it back to the right ratio, it goes sour, and nobody wants to bake financial bricks. AI is essentially your modern kitchen timer. It monitors these exact ratios and tells you precisely when a rebalancing, feeding, is due, way before your risk gets entirely out of hand. Moving on to Section 2, reading the market's mood. Let's talk about why sentiment often trumps numbers. So now that we see the very real problem of portfolio drift, let's explore how AI can actually read market sentiment before we even try to fix it. We hear this term thrown around a lot, so let's define it clearly. Market sentiment is the overall bullish, bearish, or neutral mood that drives decisions, and it is entirely distinct from just financial numbers on a balance sheet. Let's face it, today's markets move just as much on perception, late-night tweets, and hype as they do on pure fundamentals. Understanding sentiment means you aren't just reading raw data. You're anticipating market behavior based on human emotion.
And the crucial takeaway here is just how mathematically powerful this mood can be. A genuinely fascinating study on the Financial Times Stock Exchange 100 Index found a negative 0.7 correlation between negative Twitter sentiment and next-day market volatility. Think about that for a second. A negative 0.7 correlation is absolutely massive. It means they move tightly in opposite directions. So as online conversations turn negative and fearful today, market volatility predictably spikes tomorrow. If you aren't tracking this mood before you execute a trade, you're basically flying blind.
For example, look at the modern Techie II Fear and Greed Index compared to older tools like the Crypto Index. The AI Index pulls 13 weighted signals, things like compute costs, enterprise adoption, and the tone of the news. And here's the kicker, it updates every single hour. The older Crypto Index, it uses about 6 signals and updates daily. We desperately need this broader, hourly transparency because it's what helps us separate the superficial internet noise from genuine, structural shifts in market conviction.
Section 3. Stress testing your portfolio. Let's dig into understanding impact.
Knowing the market's mood is incredibly powerful, sure, but we have to shift the narrative slightly. Knowing the mood is great, but we absolutely must stress test how a potential trade fits into our specific personal portfolio before pulling the trigger. According to research on portfolio analytics tools, this is a massive blind spot for retail investors. You must check the portfolio impact before execution, not after. Tools like Sigma act as a pre-trade shield. They show you exactly how a proposed transaction will alter your diversification, your risk, and your yield. It stops you from buying what looks like a great company in isolation, but accidentally ruins your portfolio because it completely duplicates an ETF holding you already own.
And the financial reward for this kind of discipline is staggering.
Vanguard data shows that disciplined rules-based annual rebalancing generates up to 0.5% more annualized return over a neglected portfolio. Now, 0.5% might sound tiny, but over a 30-year horizon on a $250,000 portfolio, that 0.5% compounds to roughly $80,000 to $130,000 in extra wealth. That is literally the size of most index fund expense ratios operating in reverse entirely in your favor.
Okay, wait, stop right there. Before we rush out to aggressively rebalance, we have to deliberately slow down and look at the common mistakes that completely wipe out those very gains. More is not better. Rebalancing monthly just increases costs without improving your returns. Trusting AI blindly? That's a huge trap. AI can and does hallucinate. Ignoring tax lots in a taxable account, meaning which specific shares you actually sell, can trigger a massive, completely unnecessary capital gains bill. Panic selling during a drawdown simply breaks the rules. And finally, forgetting foreign exchange friction, those sneaky hidden fees when swapping international currencies, can eat up to 0.5% in hidden spread costs alone. You must be aware of these pitfalls.
Section 4. Spotting the next crash. How to analyze systemic market risks.
Let's pull back and move into the macro view. How do we use pre-trade analysis to spot systemic, market-wide crashes before they wipe out our perfectly rebalanced portfolios? Well, this brings us to a fascinating academic thesis from Torino, which tested how to predict extreme, nonlinear events. The researcher pointed out that traditional linear models completely fail to grasp the nature of financial panic. Markets have what statisticians call fat tails, which is basically a nerdy way of saying extreme, impossible-seeming price movements happen way more often than normal models predict. Panic is explosive, it's nonlinear. Linear models are simply ill-equipped to simulate the sudden breakdown of normal market correlations.
But what's incredibly interesting here is the contrast in the models they tested. Yes, advanced machine learning like LSTM is highly precise because it understands deep patterns over time. But a traditional logistic regression model remains surprisingly competitive. Why? Because of parsimony, meaning the simplest explanation is usually the best one. In highly chaotic environments, a simple model captures the loud, blaring signal of panic much better than a complex one. The thesis concluded that logistic regression is a brilliant, highly sensitive early warning system for risk, while machine learning is a more refined precision tool.
Section 5. Explainable AI and Alpha. The absolute power of transparent scoring.
So how do we transition from academic models to actionable tools? We need systems that everyday retail investors can actually trust and understand. Let's look at how a platform like Danafin structures this. Every single day, their AI brain crunches over 10,000 data points per stock and organizes them into 3 distinct buckets. Fundamental data, which is the financial health like PE ratios. Technical data, checking price trends and momentum. And sentiment data, parsing the news and social media buzz. It ranks these contextually, adapting to shifting market conditions over a rolling 12-month learning window.
But the true magic here is transparency. Modern tools aren't black boxes where some magic, unquestionable number spits out. They use explainable AI, which shows you exactly which signals, like a strong fundamental financial health score or a high short float showing how many people are actively betting against the stock, are driving the final rating. It completely replaces emotional gut feeling with impartial, objective data scoring, allowing you to see the exact math under the hood before you make your trade.
Finally, Section 6, the modern investor's workflow, your 5-step framework.
Okay, let's bring all these threads together. We've talked about drift, sentiment, stress testing, and explainable AI. But how do you actually do this today? Here is the concrete 5-step framework recommended by MoneyFlock. First, export your current allocation from your broker. Second, feed it to an AI and compare it to your target percentages to check for drift. Third, ask the AI to stress test how a 20% market drawdown would specifically impact you. Fourth, have the AI generate a tax-aware trade list, using new contributions or dividends first before ever selling your winners. And fifth, verify and execute.
Wait, stop right there before you finish that last step. This is perhaps the most crucial warning of this entire explainer. Never, ever let the AI place orders directly. Large language models can and do hallucinate share counts. They might get the dollar amounts perfectly right, but then invent a ticker symbol or mess up the share division. In fact, roughly 1 in 12 AI rebalance prompts ship with a share count error. Always verify the math in a dedicated calculator and execute the final trade yourself. And this brilliant thought sums up the exact balance we need to strike. AI handles the rebalancing, an advisor handles the panic.
AI is absolutely incredible at math, summarization, and rules-based drift analysis, but it lacks behavioral coaching. It cannot hold your hand during a 30% market crash. You use the AI for the heavy lifting of the pre-trade data, but you rely on human emotional intelligence to actually stick to the plan.
Which leaves us with this final thought. We've seen that AI can analyze 10,000 daily data points, read the internet's mood hourly, and detect the mathematical precursors to market panic. So if the tools to do all of this exist right now, literally at our fingertips, is your portfolio still running on gut feeling? Thanks for joining me on this explainer. Keep learning, keep analyzing, and I'll see you next time.